Welcome. Welcome to MIT Sloan Finance Day. You know our theme, financial markets in transition. Of course, that theme could as well have been financial institutions in transition. It could as well have been finance in transition. This is a time of dramatic change. It's a time when MIT and its broad community appropriately gathers to consider what's been happening, to consider what needs to happen, and to challenge each other to help create the kinds of futures in this important area of the economy that the world needs. I want to express a particular thanks on all our behalf to our speakers and panelists who have chosen to come together this afternoon. I'm going to make a terrible joke, and I'm going to get in trouble with my colleagues by saying that it might not be the case that every single day in Cambridge, Massachusetts, we have quite this strong an assemblage of faculty talent. But it is an amazing assemblage of faculty talent. And I'm going to do a high wire act here by attempting to say a thank you to Stu Myers, Bob Merton, Andrew Lowe, Professor Antoinette Shore, Professor Ricardo Caballero of MIT's Economics Department, Professor Deborah Lucas, Professor Stephen Ross. We also have Professor John Minahan and John Parsons here today. I think Doug Breeden may be with us. Just an extraordinary group of MIT leaders, including, of course, leaders from our alumni and friends who have so many important responsibilities and have played leadership roles through this challenging time and going forward. If I could, I'd like to recognize one group, two groups actually, of our leaders in finance, many of whom have representatives here today. The finance group has an advisory board of leaders who have helped it and challenged that group to do the research that's needed, to create the outreach that's needed to have the kind of impact that we need. We also have an MIT Sloan executive board with multiple members here today, some of whom have come from Asia, in fact, to be here in New York this afternoon. If I could ask, please, the members of the Finance Group Advisory Board and MIT Sloan Executive Committee members to stand, please, just for a moment. Come on, come on, come on. You have to do it. Thank you. Thank you so much. We also have some sponsors here today who have helped our finance students conduct practice-based, experience-based research, which is so very important in developing the kinds of leaders that any part of the economy needs, leaders who have the kind of resiliency, the kind of true north that this sector and other sectors require going ahead. I want to thank all of our alumni for supporting the school, for gathering here today. And we have a number of MIT Sloan students here today. Can I ask the students to raise their hands? Welcome. So, we've all agreed that this will not be the long deanly welcome, but I'd like to make just a couple points about finance and about this school. I'm proud of finance at MIT Sloan. When I was able to join the school with such good fortune in 2007, it was among my most important commitments that we will have and hold the high ground in finance. We have the people who are the right people to lead this sector forward. We have the history. It is, in fact, the case. If modern finance was invented in any one place, it was invented at MIT. It was not invented in Philadelphia. It was not invented in Chicago or any other place. There comes with that a responsibility that this school's faculty have taken up and take up today to be real leaders, This is the faculty that was saying, to a great degree, what the world needed to hear in 2005, 2006, and 2007. This is the faculty that came together in 2007 and 2008 to create a new program, the Master of Finance, designed to be an important part of the solution to what the world needs in finance, not part of the problem. I stand with our finance faculty in believing that financial systems are going to become more complex, not less complex, whether we like it or not. And we need leaders in this sector, in government, who understand that complexity and can drive the kinds of policies and practices that that complexity is going to demand. So as we launched the Master of Finance program, a somewhat controversial program, as you might imagine, in 2008, it became one of the visible manifestations of this school's commitment, or maybe for some of you, recommitment, to leadership in this important area. Our programs have done extremely well during the last 3 years. In fact, for much of that period, the Master of Finance program has been the most selective professional master's program at MIT. We have over 10 applicants per seat in that program. In fact, over 10 applicants per seat in our MBA program. During the last 3 years, for both programs, our students have done extremely well with respect to opportunities with leading organizations in the United States and worldwide. There's been a lot of other activity at the school. The very brief versions have to do with continuing leadership in experience-based learning, project learning, action learning in the US and around the world. We have a new home, as I hope you know, for MIT's Sloan School of Management. Our physical facilities in E62, how many have been there? Students, it doesn't. I hope the students have been there. It's not a Temple degreed. It is a place that has great views of the Charles. If you haven't come and seen it, you should. But most importantly, it's a place that's designed to bring our faculty together to work on the most important issues across the traditional boundaries for faculty, and to bring our students together with great companies to do the kinds of project-based learning that we need to do very well. We also just last year opened E60, a new suite for alumni, external relations, and a dean's office. And going forward over the next year and a half, we'll have a complete renovation of E52. Some of you may remember the Sloan building. And that will complete the physical infrastructure that we need, together with the incredible faculty and students, to take us where we need to go. Thanks for gathering this afternoon. It's now my very brief task to introduce to you your Master of Ceremonies for this afternoon, Professor Stuart Myers, the Robert C. Merton Professor of Finance at MIT's Sloan School of Management. You know that Stu Myers' work relates to the valuation of real and financial assets, that he does work on corporate finance policy and practice, and also research on the impact and design of financial regulation. He's been the president of the American Finance Association, in addition to many, many publications. His textbook, Principles of Corporate Finance, is the leader now in its 10th edition. And as a part of his outreach, he continues as a principal of the Brattle Group. Please welcome one of MIT Sloan's legends, Stu Myers.
Well, thank you, and welcome everybody. I thought I'd start with a question. So what do you think is the first and most important message of the financial crisis? And my answer would be the first and most important lesson of the financial crisis is that finance is really important. And you all know that finance is really important. And MIT and Sloan know that finance is really important. Dave Schmittlein, when he arrived as our new dean, knew that finance was really important. And therefore, many of the initiatives that you're going to hear about this afternoon were underway before the crisis. We started work on the Masters in Finance program, I don't know when, but I guess 2006, 2007, when Dave came in and recommitted or committed Sloan to invest in finance and increase the faculty. That started happening before the crisis. All of the things you're going to hear about that have to do with the size of the faculty, the composition of the faculty, and the programs that either are new or expanded happened before the crisis, and therefore at exactly the right time. Because now that we all know, not only we know that finance is important, but also politicians and journalists and the general public know that finance is really important. MIT has the programs and investment in place to respond and not only make finance important, but effective and efficient and, to the extent possible, fair. Now, this afternoon, we are going to have a wonderful cross-section of presentations on research in finance and also the MFin, Masters in Finance program. You'll hear from Bob Merton talking about credit guarantees. You'll hear from Antoinette Shore talking about CEO attributes. You will hear from Steve Ross about how to forecast the stock market. Well, Steve is actually not going to tell you exactly how to forecast the stock market, but he's giving you a methodology, a really innovative methodology that may help understand or help us extract investors' expectations about the stock market and important variables like the market risk premium. And of course, there will be a panel discussion on financial policy. So it's a broad range of topics. And I was about to say that it covers the span from theory to practice, but I bit my tongue because that Manichaean contrast of theory and practice, I think, is not so useful. When people say those two words, they often have versus in the middle. And I think at MIT, that's not the way it works. So I'm going to suggest that you might want to think about Myers's magic triangle of finance, okay? And I should have done a slide, but you can imagine a triangle, yes? Okay, and you have things going on at each corner of the triangle. What's at the top doesn't really matter, but let's say the top is theory, which means ideas, hypotheses, models, things that either put a new interpretation on what's going on in the world or a new hypothesis can be tested. So think of that at the top. Now we'll go down to this corner, and at that corner I would put data and testing. Hypothesis isn't any good unless you can test it and potentially reject it. And you can't have theory without testing. And then over at the third corner, we're going to put how to do it. That is the actual application of what we know about the world and what our theories tell us to decisions. For a corporation, it might be valuing a capital expenditure decision or a hedging program. For a trading desk, it might be valuing or hedging a book of business. For a government, well, now you see I've gotten myself in problem because I've got three nodes to the triangle, three corners. One of them is theory, one of them is data and testing, and another one is how to do it. And by the way, I think that the interaction between what's happening at those three corners of the triangle is what really makes finance work. MIT, I've been very lucky at MIT to work with people who could work at all three corners of that triangle. And even if people are specialized, a good finance professor or a good finance practitioner, I would say, if that person is not interested in all three sides of that triangle, something is going to get missed. Now, I've got myself in a box because where's policy? Maybe I need a square. Now, policy, in a way, is a how to do it corner. But policy is a little bit different because you're actually not telling somebody how to make a decision, a financial decision. You're saying what the rules of the game for finance ought to be. And this is a mea culpa. I would say that finance at MIT and elsewhere, what we now call modern finance or financial economics, has been too passive about policy. Too passive. If you wanted to go a long way back, I can report that at MIT, in our finance group meetings, we understood the savings and loan crisis before and as it was happening. But mea culpa, we did not go down to Washington and beat the drums hard enough to try to influence what was either to prevent the crisis or to influence what was being done about it. We're getting better at that in finance, but that's another thing that the Sloan School, I think, is going to, another area where the Sloan School is going to be much more prominent and important going forward. And in fact, several of the talks this afternoon, although they're finance-based, also have to do with policy, starting with Bob Merton's talk, but also the panel that will come later on financial reform and so on. That's what I'd like to say by way of introduction, my introduction, and now let's switch and introduce Bob Merton, if I may do so for just a second. So Bob is the, gotta find your title, Bob. The School of Management Distinguished Professor of Finance, and of course a Nobel Prize winner in economics. And he spent his whole career at MIT since he came as a PhD student, except for 20 years at Harvard Business School. So, where he actually retired as a university professor and came back to a tenured and permanent faculty position at MIT. And if I may now speak personally, Bob, instead of just going down your list of awards, Bob and I go all the way back to, in Bob's case, 1970. We were the original cohort of, we were some of the original cohort of people at MIT that I think it's fair to say added a lot to the whole field of finance. I'm a little bit older than Bob, but not much, and it doesn't show anyway. So I regard you and I as contemporaries, you and me as contemporaries. So at the time, I was there at the creation when Fisher Black, Myron Scholes, and Bob created option pricing, but it was more than just the Black-Scholes formula. It was dynamic hedging, it was continuous time finance, and, well, let me jump ahead. If you wanted to go and read one book that demonstrates what a flowering of intellectual activity and practical applications came out of that work, read Bob's book on continuous time finance. It's not just the depth of the analysis, but the scope of analysis and the applications, which I always found very amazing, really amazing. So we have Bob back at MIT, and he's been working on policy. I would say, Bob, a general understanding of how financial markets and institutions work and how you can make them work better. And I think his talk, which is coming up, will illustrate. So can I ask you to step up, please? Bob Merton.
Well, Stu, thank you for that and the personal parts, and everything you say is true. It's really amazing to look back at where it all started, but if I talk about that, I'll never get to the topic for the day. First, I want to thank you all for coming. It's a great treat for me to see so many of you. It's hard to believe when I see some of the people how many years it's been since you were students and I was in the classroom with you. But this is really a great treat. So for my topic today, Stu said we're going to look at some issues from the financial crisis. And I wanted to think, the crisis of 2008 or 9, which is really still with us today, is of course enormously complex and multidimensional. We still today don't know all the important facts necessary to properly explain, blame, or fix its causes. So I thought I'd select a few issues Given the occasion, I wanted to make sure we use tools that many of you already know because you went to Sloan, but some may have not worked on in a while, so we'll do a little quick refresher to apply it in the context to two issues, the issues of credit risk and guarantees. And from those, as you're probably aware, we're pretty clear that the center of the crisis was around credit and money markets, that critical policy tools implemented during the peak of the crisis involved guarantees of all sorts, TARP, the Federal Reserve, and they continue to this day. And the question is, what are the implications of that? And in my development, I hope to develop some insights into the following. First, make sure we have some understanding of how the enormous risks that, at least from most of the population looking at it, came out of nowhere and then suddenly exploded. Some people refer to them as, I don't know, black swans or some other, credit events. And I want to suggest that actually they were building up, and the question is, how were they able to build up in such size without being recognized, at least in the area of credit? And I'd like to exemplify that in looking at that period of time. Then I want to give some insights into the present, such as European Financial Stability Facility, ECB, Fed, Bank of England policies. I'm not going to get deeply into them, but issues of the present. And included in that is the issues of liabilities of the governments in the US and Europe. I need hardly say to you all the discussions that have gone about the debt problem, liabilities. And while that's certainly there, one of the things I want to bring out is that there are other liabilities that aren't measured as part of the debt, but are indeed liabilities of the government, and to see how by not recognizing them, we may have some distortions of reality, and in that process, perhaps not choose the best policies or policies that could be better if we did. And that's in the area of guarantees. And then finally, I'd like to be looking to the future. And I want to talk about how we can improve the techniques and tools that are needed to analyze and predict macro financial risk propagation and the buildup of that risk using the modern tools of finance. So on one hand, the tools we'll use are very familiar to all of you. These are not some new, I don't have some new squiggle to give you today, sorry, wish I did. But what I want us to bring out is how those tools, which most all of you have been exposed to either in school or have used since, can be applied to these major issues in the area of policy, systemic risk, and macro-financial risk. I will not, however, comment on current policy. I know better than to do that. There are many here who can say much more. So that's my agenda. I'd like to start out, those of you remember, I never use this sort of stuff in class, so if I screw up with it, it won't be you shouldn't be shocked. But anyway, I thought I'd put up here a balance sheet. This is the courtesy of Debbie Lucas, my colleague's work that she's done that I borrowed from her, or she lent to me, which is not a government gap, I've forgotten what that's called, accounting balance sheet, but rather what we would call managerial accounting, the thing we need for actual decisions, what's really going on. And what I wanted to call attention to on the right side here, the first line, which we've all heard the numbers, is Treasury debt held by the public. That's the debt they talk about, $9 trillion. Well, of course, it was $9 trillion, when was this, November of 2010. It's now about 10.5, approaching 11 trillion at the moment. So I can't keep it updated, but if it was one of those signs, that's a pretty big number. That's right, 2/3 of GDP, or good GDP, maybe not where GDP is now. What I want to focus on here is, in the data, is a whole bunch of other liabilities. Am I getting this sparker? Yeah, there it is. See these liabilities here? These are the off-balance sheet pieces. These are the guarantees. Now, the guarantees include all kinds of things, loan financing. I'll give you a list in a moment just to remind you. but you have guaranteed loan financing. Then you have Fannie and Freddie that are effectively guaranteed. They have special attention here. And then you have all the off-balance sheet financing, which includes FDIC, Home Loan Bank, the PBGC for pensions, the Federal Reserve, all those guarantees. Now, to be fair, these numbers are not the liability values. Those are the quantities of the debts that are guaranteed. So don't get shocked. If those were the actual numbers of the liabilities, I think you'd all leave the room now and make some quick phone calls, okay? But that adds up to $17 trillion. And guaranteeing $17 trillion is not a $17 trillion liability, but it's a pretty big one. And if you add it to 10 trillion, you get a somewhat different number. And that's really the basic message that I wanted you to see from this slide at the beginning, that these are large, that while these are contingent liabilities, unlike debt, meaning like insurance policies, because that's what guarantees are, if the event that you're insuring against doesn't occur, you're okay. The alternative is if the event does occur, you're in a whole lot of trouble. And these are not like entitlements. You know, people are always throwing Social Security and everything else in there and getting numbers that are astronomical, because those numbers, as entitlements, Congress can change. They're kind of more like preferred stock, okay? I know, this is an abstract concept for most of you, but as Stu pointed out to you, thank you, Stu, I qualify, okay? I am worried about my Social Security payment, okay? So, but these are like debt in the sense that you can't walk away from these guarantees without defaulting. Congress can't change them. At least I don't think so. Okay? You always have to be a little careful when you're interpreting the law. All right. So in order to get you through this, I'm going to have to take you back to school. Many of you will see this as a review, but that's okay. Then it's always good to start out with something familiar, because you're all going to have to become credit experts. And looking at the time here, we're going to have to do it in about 10 minutes. Actually, you'll probably know more than a lot of people making decisions. Anyway, okay. I don't really mean that. No. Whoops. I knew I pushed the wrong button. There we go. Yep. I alerted you. There. Okay, so what I've put up here is a kind of a basic balance sheet to try to explain to you about credit. So to do this, I have here, now I'm doing corporate debt alone. If you prefer, we can do a home mortgage if you like the household. Just change the labels up there. Corporation, put household. Operating assets, put house. Debt, put mortgage. And equity, put net worth. So it works for either one. So I've got a loan. Here I have a full faith and credit U.S. government guarantee. Staple them, and what do we have? Functionally. Basically, a risk-free asset, something to substitute for U.S. Treasury. It doesn't have the tax treatment, but basically it's the risk-free asset. Why? Because if the lender doesn't pay you, the government will. Okay? So if that's the case, now let's rip the guarantee off, and we're back to the loan. What do we have? Well, if the two together was risk-free debt, what is this? It's risk-free debt, a guarantee. Remember, I just ripped it off. So what we see functionally here is the first step. The first step is every time there's a loan made, you're really in two activities. You're lending money risk-free, which we all understand. That's well defined. You lend money now, you get money plus interest, not much, back later, for sure. That's time value of money. What else are you in the business of? You're writing a guarantee. Well, guarantees are insurance. So you're in the insurance business, which is very different than the lending business. Now, you may be a little smidge in insurance business if it's a high-grade loan, or you could be a lot if it's a crummy loan, but that's just a matter of quantity. The key here is that you're in both those businesses. Both are honorable businesses. Insurance companies are institutions that have been around for centuries, performing good functions, but it's important to know that you are in that business. Okay? Now, how does the guarantee work? What is the structure of the guarantee? And here I go to the balance sheet, and you all could be comfortable that the left side always equals the right side. That's an identity. That's not a theory, remember. That assets equal debt plus equity. And so if we look at that, we ask the question, on the date of destiny where you have to pay off the debt, there's some promised payment, the face value, B dollars, all right? One of two things happen. You either get paid or you don't. And it's a pretty good bet that if the value of the assets, the real value of the assets, exceed what's owed, you'll get paid. Because the shareholders would like to have the residual. But if it's worth less, you aren't going to get paid. And leaving out all the institutional details, basically, what is your recourse? You get the assets. Okay? So, what is the value of the guarantee? In the event that you're paid, it turns out to be worthless, like lots of insurance we buy. When you buy it, you didn't need it. But if it turns out that the company can't pay, then you get the difference between the promised payment and what you would have recovered if you'd taken the assets, B minus A. I've written it up here as a formula I hope is very familiar to this audience. Maximum of 0, B minus A. But just in case you've forgotten, that's a payoff to a put option. A put option with a strike price equal to the face value of the debt or the principal of the debt. The asset is the asset of the borrower, and the due date, expiration date is the maturity date. Now, what does that buy us? That shows us that essentially, to understand the value of a guarantee and its risk, it's the same as a put option. Now, happily, in 2012, we as a profession have been pretty involved with valuing put options for almost 4 decades. Okay? So we have experience as well as theories to do it. So this was one of my shorthands to make you credit experts. If you know what a put option is, we've gotten you a long way to doing it without having to toil in that particular vineyard on the usual time. And so we see that that gives us a way to do valuations. Now, the last point I want to make from this is credit default swaps, which of course were a big part of the crisis, CDS, all right? Take any mystery out of it, they're basically just guarantees of debt. So they're like put options. So now we've kind of covered the land. That's your class. End of class. Now we go back to work. You're going to apply this. Okay. So with that, let's go forward and let's look at the buildup of risk. And any loan, as we saw, is risk-free lending minus a put option. You've written a put option. The risk-free loan part of it is not interesting. So let's focus on the put option, the guarantee. And here we've put up for you a generic picture of the value of the guarantee, which implicitly a bank is giving when it gives a loan. Remember, they write a put, okay? And here are the assets, and everyone will agree that that shape is the value, something like that, the value function. That's not Black-Scholes, that's almost anyone's model of put option pricing, so we're not dependent on that. If we start here, if that's where the assets are, that's what the guarantee is worth. If that's where the debt's worth. We look at what happens when the asset goes down. Surprise, surprise, the value of the guarantee or the put goes up. That's not surprising. But what else happens? And this is the part that's more subtle. Not for you, but for the rest of the world. Do you see the slope there? We all understand that it's part of the Greeks. That's the delta. That's the sensitivity of the value of this guarantee to movements in the underlying asset or the collateral. And we see for small moves that, roughly speaking, if there's a small move in the asset, the amount of the guarantee change will be something along that slope. Notice what happens when we get to the lower asset level. Not only does the guarantee go up in value, but what else do you see from the picture? The slope gets steeper in absolute value. What is that telling us? 2 things happened when that asset went down. The guarantee went up, the value of the loans went down, but also the risk of the same loan went up. And if you had another decline, again, the guarantee would get more, and the risk would even get larger. It's the second one, which every derivatives person knows. Every derivatives person in the derivatives business knows this. How can I say such a profound statement? I see Andrew looking at me saying, everyone? I say, yes, because if you didn't know it, you're no longer in the business. But in the loan area, as many of you may know, that's not necessarily how things are accounted for or discussed. You don't see things being marked in that way. In fact, it's frequently the case they say, all loans are still performing. We haven't increased the loans. Therefore, the value is the same and the risk is the same. We haven't changed anything. But if, in fact, the underlying assets have fallen in value, you know that the values had to change, and you know the risk it had to change. And so you can have a buildup in loan books that are not marked and are not treated like derivative books, like a put option book where you take account of the changing risk, that appear to be just fine until you get to a point where you can't avoid noticing that you've got a heck of a lot of risk and a heck of a lot less value than you have on the book. That looks like, holy cow, shock. But you see, it actually was in part due to the accounting and the treatment of the book. So I just wanted to see one way, and this is only one, in which you can have risks build up through a combination of accounting and the practices, in which they're not recognized, and then when they do hit, they appear to be a major shock. And this will explain another other functions. I want to use this because I want to talk about the macro risk propagation to look at the case of the government now. What does the government do, let's say FDIC, and also beyond that, as we've seen? The government gets guarantees of deposits. We've seen it's guaranteed all kinds of things, money market funds. It's guaranteed things that weren't guaranteed before, okay? But let's just deal with the deposits. If they guaranteed the bank deposits, they're really doing what? They're writing a put option on what? The bank assets. What are the bank assets? Risk-free lending, that's good, minus a put. So basically, they're guaranteeing the insurance policies being written by the banks to their borrowers, the puts. They're doing puts on puts. Now, this kind of shape, you being MIT, has a jargon term. First of all, it's a mathematical term. It's convex. And that convexity is the jargon term for saying the risk changes. It's nonlinear, okay? So what would you guess is if you have a convex function of a convex function? It's really convex based on the underlying. So what does that tell you? That tells you that the curvature relative to the real assets that are driving this, corporate assets, residential housing assets, the things that are there, that the amount that things can change in terms of value and risk can be quite dramatic. So you can be going along with almost very little risk to a government. And if you have a real estate crisis, as happened, for example, in the 97 Asian crisis in some countries, things can build up, and then suddenly you can find yourself in a whole lot of trouble. So this double convexity is a way of seeing how it can propagate through the system. You have a shock to the value of assets, for example, that hits the banks through this mechanism, increasing risk as well as lowering capital values. And then you hit governments because governments are guaranteeing the guarantees. And then you have feedbacks, which I will come back to. So all of this, many of you know, but I wanted to make sure that we went and set all of this up for those who might have not looked at it this way in a while. So with that in mind, now let's talk about a particular class of guarantees. The guarantees, by the way, the guarantees I referred to with respect to the Fed and so forth in the crisis, let's be clear. The U.S. government has been the largest guarantee writer for a long time, long before the crisis. They've guaranteed mortgages, deposit insurance, small business loans, student loans. That may have been in the newspapers from now to now, and we've reached very large numbers. As I mentioned, pensions. Other sovereigns, we give foreign aid in the form of guarantees. The NGOs, Fannie and Freddie, farm loans, money market funds, synthetic panel companies, solar companies, synthetic fuels. So there are a ton of guarantees out there, all with this property. And they're all part of the government structure. Okay? So as we go to here, what I wanted to point out to you here is a particularly destructive feedback loop that can happen with guarantees. And the general principle is the following. I'm a guarantor. I guarantee our dean's credit, something of his. Now, that's a joke, right? But let's not talk about how good a guarantor I am. Let's just say I do it. But then he turns around and guarantees my credit. And he says, well, is there something circular here? Yes, there is. Who would do that? I mean, who sensibly would do that? Well, let's take a look. A typical example, as I put up here, is you have a government for Region X whose debt is held by financial institutions, banks. Now, we know what that debt is. That debt is risk-free minus a guarantee. A guarantee of what? The bank is writing a guarantee of the government. You just saw that from the structure. So the banks are guaranteeing the government when they buy government debt. But then the government guarantees the banks. So what you have is that the institution whose liability is guaranteed by X. So you can see what happens, and I'll show you in the next slide a more complex, complete version. But you can begin to see where this is going to go. Another version, FDIC issues its own debt. Who buys it? Banks. Banks what? That are guaranteed by FDIC. Now you can say, well, it doesn't matter, FDIC will never fail. Agreed. If something's never going to fail, then a guarantee of it is not a problem. But as we've seen, things that we thought would never fail, now people are questioning, and I'll have something to say about that as well. The Pension Benefit Guarantee Corp, you may know, guarantees corporate pensions up to a limit. Do you know what the advisory board? I hope nobody from here is on it. If they are, I'm sorry, nothing personal. But the advisory board to the PBGC suggested that the assets of the PBGC, which is an insurance company, it's writing guarantees, should be in what? Equities. Why? Because in the long term, these are long-term liabilities. Think about that. Under what state of the world does the PBGC need assets? When they got to take over pensions. When do they take over pensions? When the companies can't pay their pensions. If a company can't pay its pension, its debt, what happens to the equity of that company? Right? So it's not that the assets aren't worth what they are when you buy them, they just aren't worth things when you need them. Now, I'm not making this up. So you can just see these are major policies. And I understand there are reasons for this and so forth. I don't want to make a joke out of it, but you've had corporations who write a CDS contract on their own debt. They already wrote that contract when they issued the debt, so they just issued it again. Someone pays them for it. Well, okay. And then you could see it, the same thing would happen with, as I mentioned, the PBGC. It's not allowed, but if we allowed it, imagine the corporations funded their pensions with their own stock. That's equivalent of not funding. And then I say, they have companies who do write put options on their own stock. They're writing insurance, again, on the very thing that they are supposed to call assured. So we see this happen in Fed. Now let me take you to a slide which I've, with permission, gotten from my co-author of various times, but the fellow who has really spent the last 10 years of his life dedicated to this particular area and is finally bearing fruit, and that's Dale Gray. But in showing you here, I don't know how well you can see all that's going on, but what we have here going on in this picture is the effect of, if there is some reason a fall in, say, in government bonds price, government bonds go down. Have we seen that at all, let's say in Europe, for example, from time to time, week in and week out? So imagine a shock, for whatever reason, in which we start with a fall in government bonds that are held by local banks. So not to pick on anybody, but let's say a French bank and a French debt, or a Spanish bank with Spanish debt, holding Spanish government debt. So what happens? The value of the debt goes down, therefore the value of the assets of that bank go down, its capital goes down, or should go down, right? Its value goes down. Its funding then becomes increased, it's at more risk, all right? Now, what happens is, because the government bonds are going down, not because interest rates are going up, but because of fear of risk, because the government is not as strong as it was. There's erosion in the belief that the government will be able to protect the bank, because remember, it's really guaranteeing the banks, either explicitly or implicitly, as we've seen. Let's not distinguish. And then what happens is you also have going on, and this is particular for Europe, I think those of you have thought about it, is part of the complexity in Europe, that the banks don't just hold their own country's bonds, they hold each other's bonds. And so you have mark-to-market fall in the bonds held by foreign banks, okay? And they get into exactly the same sort of pressures that the local banks are, because they are not guaranteed by the one they're holding, but their assets go down, their capital goes down, and puts pressure on their government, who's guaranteeing their assets. So now you have different governments being brought in and finding their position being eroded. And then you go through this thing. At the same time, you have banks, foreign and local banks, stop trusting each other in terms of lending. So you have that going on between the banks. And then you have the withdrawal of funding from those risky banks, and it all feeds back through the system. And that's how you get that feedback loop. I'm not going to delay it, of what I referred to on the first slide. And it can be pretty dramatic. And, you know, one could ask the question, why do we have that, or why haven't we figured that out beforehand, or had we and we're just letting it go? I'll leave that for you to answer. But I think at least it makes transparent both the mechanism and, in Dale's case, the magnitude. Now, in this slide, I'm looking at the clock. Don't worry, she's still eating, so I'm okay. She gets the dessert, I know I'm in trouble. I'm just going to bring this up. This is a little aside. I tried this on some of my colleagues, people like Jim Paterba, who are serious people in this area, and they at least didn't laugh at me. So as trivial as it is, there's all this talk about we're not getting enough risk-free assets, you know, where there's been a contraction in those. And even in the United States during, remember, the debt ceiling crisis, and maybe we'll have it again next time out, okay, could we default here? Now, I think most of us would agree that a default would be a political default, that it's not because we can't pay, but nevertheless, we were downgraded, you know, for whatever reason. So the question is not should you do this, but suppose you wanted to create a more risk-free asset. Well, we know that countries, unlike in the euro, but other countries, US, UK, in theory, they could just print the money. And if they commit to do that, then the debt should be risk-free. Now, it may be, you know, you want to be buying tips at that time rather than nominal bonds if it's a lot of money. But the point of the matter is that then you sort of say they're committed to do it. But as we know, that's not an automatic. We've seen countries default on their debt in their own currency. Of course, Russia in '98 being an example. But there is a danger that the central bank says, sorry, we aren't going to print it, or whatever. So what I was going to suggest here, it won't take much longer, and you can play with it. How about we change the rules, and on full faith and credit U.S. Treasuries, only on those, just like we distinguish with agency bonds, but something we call full faith and credit, we put a provision in that any coupon or principal that came due and was not paid, so it's come due, should have been paid, wasn't paid, for whatever reason, that you can pay any federal tax using the face value of that coupon or principal amount. Now, think about that. Even in really tough times, when governments might default, they still have to raise taxes. So, as a holder, you don't have to go to the government and say, please give me my money. You or someone you sell the bond to goes to the government and says, I owe you the money here. Okay? And so the idea would be, this would be a way to put fiscal and monetary assurances. You know, right now it's all monetary, print the money. This was just a thought. Now, I don't want to belabor it, but it's just something to put out there. I do put down here, though, that because of the paradox of too much power the government has, and that paradox is that Stu and I can enter into a contract under New York law that if I don't perform, he can put me in bankruptcy and vice versa. But the problem with government is you can't really do that because they can change the rules. We've seen that. That's why they can't commit to Social Security, because they have the right to change the rules. So even if they swear to you and take the lie detector test, it's not a credible thing. So it's a paradox of too much power. Government can't actually commit to things that Stu and I can. Okay? It's because of that, in order to make this effective, because think of when they wouldn't pay, it's going to be a pretty stressful time. It would have to be something like a constitutional amendment. Now, I'm not talking about a balanced budget. That's a quite different discussion. But just simply saying that this would be a constitutional right. I don't know. I'll leave that to you. This is just a little snippet. It fits in here if you were looking for real things. Now, in my final minutes or talk before I go to questions, I'd like to then turn to the issue of the future. Looking to the future, and this fits in with our MFin program, where we're going to create large numbers of highly trained MIT finance people, short on experience, long on, as Stu's triangle, okay? We're going to give them practicum. There are several of the people who graduated from Sloan who have illustrious careers and so forth, who come back and taught in our practicum courses. So we're taking advantage of that, along with the empirical work and data and all of that. We're training all these people to go out and be there, both in the public sector as well as the private sector, to be there. We need to improve the tools for both measuring macro financial propagation and policies to identify systemic risk and allow us to have a better understanding. And again, this is coming out of the work that under the hood is exactly out of finance. You saw the piece I took you through with the put options. What this system does is build the whole macro system of the financial interfaces between all the sectors of the economy and across geopolitical borders, of all the options that are embedded, all the guarantees, all the connections, and builds them as options, structure, okay? And therefore, when you have changes in things like volatility even, or other parameters, they feed into the system in a way that the standard models don't pick up. And so the idea here is to have a much richer structure with respect to the risk properties than the typical macro models have. And this has been built. It's been built over 10 years and applied, first with Moody's, and then now with a variety of central banks around the world and other governments. Even the CIA has shown an interest in this. Remember, they are an intelligence agency, right? So in terms of understanding how these risk flows that I took you through happen. And so the idea here is to integrate the financial stability, the risk elements that are missing from macro models into monetary and fiscal and debt policies in a way that's practical and can be done. This is not just sitting on a slip of paper. It actually can be done. It has been done, is being done, and has a lot of interest. This is still for the future, but it's the impending future, not the future 10, 20 years from now, okay? And what I'm trying to do here, you know, given you're sitting out there, you are at your, you know, you finished your entrees anyway, having, and so forth, that you maybe can't see all these flows, but, you know, like the first time you hear a song, I don't know about you, first time I hear a song I like. If I don't like it, I don't worry. But if I hear a song for the first time and there's a singer, I don't understand a single word they're saying. Their song's going on, blah, 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 blah. I have no idea what the singer is saying. And then I hear the song about 20 times, and then I learn what they're saying. Well, so in that spirit, looking at this picture and listening to me, if you don't get all the lyrics, I hope you get the tune. Look at this. This is all the interplays, the feedbacks, the things that are informed by risk, using markets as the inputs as well as forecasts coming out of macro data, but actual markets and how they feed through everything from where vol is and all that kind of thing through the system to give you a feedback and give you the ability, if you want to do simulations or experimentations with policies, how you get all the feedbacks. Now, no model is complete, but much more than I believe you find in the standard or even in the advanced models you find at places like the New York Fed. Not putting them down, it's just simply saying this is an improvement. And we believe it's an order one improvement in terms of picking up on these these measures. So you see all these flows? Take a picture in your mind of this quickly now, but look at it. See it all? Okay, watch. Doesn't that look a lot less crowded? You know what that is? That's that model that you were looking at where I set all the sigmas equal to 0. In other words, I take uncertainty out of the model. That's the typical macro policy model. Yeah, they throw random numbers in there, but structurally, for the most part, they don't. In actual policy models, I don't mean that there are people doing research in macro. Of course, there are people doing research in macro who deal with uncertainties. But in terms of the standard models, so if we could reverse, see that? See that? A lot missing. That's my way of conveying that to you without going through the mechanisms. So whether this is the best model is surely not. But it's a pioneering model in the sense that it's been brought to a stage, again in Stu's triangle, that implementation has been done. Real institutions, both private sector as well as official institutions, are getting engaged and looking and dealing with these models now because of need. It's not that they love it, they don't have a choice. So we're there. We need to do a lot more. If you look at the structure of this model, and I'm a co-author on the paper, so I take full responsibility for their shortcomings, okay? At least we're getting the idea out there. And that is where the research really has to begin to go on. There's much to be done, but I hope you get the message from this, the central role that finance theory, finance empirical work, and finance experience and implementation, both in academia and in practice, can have an important contribution, important influence on how we think about macro financial risk propagation, policies, and we hope being able to address some of the challenges of systemic risk. So before closing, I want to just mention, Stu, I think, alluded to it, but he said, while we've like to think we've done an awful lot at Sloan Finance, we have been a bit short on the policy side historically. SNL's was a very good example. That's no longer true. We have people who spend a lot of their time on it because they want to, and that's where we're going. And we're actually setting up a center, an MIT research center for finance and policy, in which we are going to be in that center across the Institute dealing with systemic risk issues, policy issues, and a whole host of other things as a formalization of that process. And I really do think MIT, with its engineering solution tradition, with its finance, new ideas and theory, with practice and implementation, is the right place to do this. And so I wanted to end by saying that not only does this exist, at least in its enough form that it really exists, but there's a huge opportunity, in my judgment, to move off into this area and make important contributions, which are global ones, because these systems can be applied across geopolitical borders. And in an ever more, quote, connected is the word that's often used, world, the ability to do that becomes more important. So I thank you very much. It's been a great pleasure. You haven't had to stand up. This must be some kind of record. I'm worried about myself. But if there are any questions, I'd be delighted to take them before I get off the stage.
I like the idea of paying my state income taxes with my failed Connecticut bonds. How likely is that, or is that already possible?
I'm sorry.
Sorry.
I'm sure it's my ancient ears.
How likely is it that the states will allow payment of state income taxes?
Oh, well, that's a very good. Did everybody hear the question? Or am I the only one who was a little garbled? I guess I was the only one. The principle that I laid out for the U.S. here, and I talked about a constitutional amendment, I put it in there because that's the cleanest, all right? But clearly, one could imagine that that's a tool that could be implemented first in Europe, in countries, right? Because now you would have the country themselves who will have to have taxes do this. Now, understand, that's very painful because they need the taxes. So I'm not saying they want to do this, but this is applicable there. You could do it also within a state that has an income tax or any other kinds of taxes if it's able to do it. So, yes, you could apply it there as a way to enhance the credit at a cost. You understand, you may not want that, but in that case, you don't issue those kinds of bonds. You make it transparent that we reserve the right to default on you, even if we aren't sort of running out of money. Pardon? That would be the question. If they do, we know. Yeah, no. Look, those are obligations as far as I know. Did you hear that without the microphone? All right. What about the state and local government pensions, which one of our non-MIT colleagues have estimated, at least at one point, were in the ballpark, real market, $3 trillion. Hey, what's a $3 trillion? I got your attention with the T now. That's all. It's a minimum it can do it. 780 billion won't do it anymore. But our $3 trillion. So how we're going to deal with that, I don't know. I suspect we're going to have a lot of defined contribution plans, I hope, going forward, that we don't repeat it. But yes, that would apply there if it were done, and if they can choose to do it or not. But that would be the case. So it's just a way to try to get you thinking about how you might engineer enhancements that are a little less cumbersome than some of these complex systems that people want. They want to set up a block of this or that. The other thing I wanted to point out, was mentioned on, I know this is a question time, but I just wanted to mention, on the European Stability Fund. You may recall that they were talking about getting a pot of money in, and then, like Roy Schneider in Jaws. You ever see that movie? Goes to the back of the boat, they're hunting for Jaws. Jaws comes out of the water. He goes up to Robert Shaw in the front and says, "I think you need a bigger boat." Well, we looked at the European stability, and he said, "Not big enough." Okay? But then they had a clever engineering idea. Instead of putting the debt in there, why don't we just guarantee? And, right, comes way down. And so we can do 4 times as much. Well, what did you just see on the screen that I showed you? The only difference between the debt and the guarantee is risk-free assets. And risk-free assets are not a problem. You can have any amount of that. So it's an engineering device. It's an accounting device, a political device to lower the footprint, but the risk is identical. And if you make it 4 times larger, you're making the risk 4 times larger, even if the footprint is a 4th. So that's a case where you can see it. And so using these tools, even these simple tools that all of you had, really we taught it at Sloan for 40 years, so you've all seen this. If you've gone through finance, you can't have missed it. You may have forgotten it, but you didn't miss it. Still are applicable to major issues today. Is there another question? Yes.
So as you and others at Sloan think about the policy, the contribution the school can make to policy, I wonder whether you've pondered how to actually get the right people to pay attention when we have the right ideas. I mean, you look back at this last crisis, and there are all these examples of people knowing the problem, taking it to Congress, taking it to the Fed and other places, and yet the interests inside the Beltway were way more powerful than the theory, than our ability to head it off. And I'm wondering whether we've thought about how if we develop better models, how do we hook it into the policy-making process in Washington?
Very good question, and just as there's the paradox of too much power of government, that it can't do things that Stu and I could, there are the limitations on what government can do because of that consequence. However, there are things that have already been done in a very minor way, and I don't want to open up another thing, but probably few of you know, but there's an Office of Financial Research that's been created in Washington in the Treasury to gather lots of data and do something, and this was a brainchild of several people, including Andrew Lowe, who's going to talk later. But what I would point out there that did happen in that legislation, for better or worse, is that agency that's getting this information and can do the forensics, all right, and can get data that no one could get before, all right? There will be data available that no one has ever seen. No bank, no one has, okay? And in that structure, we got a director for 6 years that goes over any president, so it's not one president, so that's one. Very importantly, the funding of this non-regulatory agency. It's not a regulatory agency, because that you don't want, okay? You don't want the watchdog to also be, because maybe the regulator's the ones at fault, okay? And you're not going to blow the whistle themselves. The funding of that agency is done directly without Congress. So there's an example where you can design an institution and get it through. It did get through. Now it can get undone like anything, but it did get through, which has the feature that it is not subject to congressional budget decisions, and therefore, as you understand, subject to a lot of influence. I agree, you can only move things so far, but many of these things, these technical things, when you shine the spotlight, as I tried to do with you during your eating, this is a pretty fast course on credit risk, but I think most people, if you spent half an hour with them who were interested, could understand this enough to say, hey, this is what's really going on, and this isn't anyone's model. This is structural, okay? That's where we come from. If we have the answers, if we have ways of answering questions, if we can shine light on things, if we better understand things, I at least maybe a bit optimistically believe we can have a big influence, and that politics will come and go, and they'll be real, but it is not going to be able to override enough information that everyone in the community, including the industry, everyone else can see. This will not be just data for the government. This will be a data for everyone. Yep.
I really like your idea about exchanging government bonds with tax credits. So suppose a scenario is there where the government really allows it and everybody is actually exchanging their bonds for tax credits, and suddenly government is not able to actually obtain any money. What do you think, how will they do their spending in that case? Would they resort to printing money for government spending?
They may. I mean, look, please let me be clear. I was not advocating that you do this. No. What I mean by that's a policy decision. And I promised, I said I wasn't going to comment on policy. I'm not advocating this. I'm giving this as an example of how, if you wanted to choose to try to do this, how you might do this to create a more risk-free asset, if that is indeed a problem. It has a cost with it. So maybe you don't do a lot of it. Maybe you have two categories of debt. Debt that is absolutely, has this provision, and debt that doesn't. Agencies don't have the same standing as treasuries, even though most all the time the government will look after the agency. But there is a way out with the agencies. You can let the PBGC go down. Now, no one thinks that'll happen, but you can do it. Do you see what I'm saying? So please, a good question, but don't hear it as something I'm advocating. It's something that's doable. And you may want to use that to solve a problem. Yes?
Sort of a follow-on question. If in fact we did do such a thing, would you see that the natural buyers of debt, U.S. debt, risk-free debt, would change? And what the implications of that would be?
Who the buyers would be?
The natural buyers, yes.
No, I was looking at it more in the context of saying that if you have a shock where there's a contraction of risk-free assets from where things were, and that contraction is such that it disturbs significantly the way things are done, the way the financial system was operating, which some people have claimed. I'm not suggesting that that is in fact the case. If you came to that conclusion, this would be one way to enhance the stock of risk-free assets. And you had a suggestion that states could do it. How much they do, that's up to the policy. So I'm more thinking of it as a response to an equilibrium we were in that has been disturbed significantly. Do you see what I'm saying? So I'm not looking for more holders of the risk-free assets.
In the context of your examples, is the financial crisis a wave function? If, for instance, the financial crisis was the shark in your Jaws example, and the solution was the big boat, is the next financial crisis going to be far larger than the shark was in that example? And do we have a boat large enough? How close did the boat come to right-size the crisis? Did we just squeak by, or did we solve the problem with a lot, of margin?
Let me just first respond by, this sounds like a question about current policy. I prefer to answer it the following way, is that's part of the analysis. That's why you need to have these feedbacks and work through all the models. I don't pretend to have the answer. I'm not up here telling you what the answer should be. I'm telling you about the process of things that we can do to develop the structure so that we can answer those questions intelligently, the very one you said. Because if you have the dynamics, if you have the feedback, that's where that answer is going to come out. What we have seen in the crisis, this I will say, this is just my opinion, is people state a hypothesis, says, hey, that might be the explanation, sounds okay to me. Next thing you know, it becomes fact. Next thing you know, you're talking about what are we going to do, who are we going to blame for it, and how we're going to fix it. Where, in fact, when you look at many of them, they weren't facts, and they are just hypotheses, and they may not have been the cause. We would not put up with that in the case of other kinds of systems. Andrew Lowe's favorite is, the National Transportation Safety Board with airline crashes. We actually want to know what the facts were, as best we can determine them, of what caused the crash. Once we know the facts, then we can have your discussion. So I'm really at the first stage. How do we build the models and the systems to set up the facts, to set up the feedbacks, to then make the policy decisions? So in that sense, it could be that system will blow up, in which case it's probably not a good idea. Or it could be that there are things you can do where it will be okay. And there isn't one answer. There's an answer to every question, but it's not the same answer. Maybe I misinterpreted your question.
It's a question not only of policy, but of tools. You could have the right policy, but not the right tools.
Right.
And if we throw everything at a crisis that we can, but we don't have enough, we're in trouble. So the real question that I had was, how close to solving, how close was the solution to the problem? Did we have enough margin to solve a bigger problem? And in the future, if you look at the S&L crisis of 20 years ago or so, far smaller than the crisis of a few years ago, the next one could be an order of magnitude larger than this one.
So we need, that's the problem. That's the challenge. I mean, I can't tell you the answer to that. I can tell you how I think that what we're talking about is the way I would believe is a good approach. Others may have other approaches, but I happen to think this is a good approach to address your question. I don't know the answer, and I think the answer will depend very much on the conditions. Sometimes it won't be as big a problem. We'll figure out how to do it. Sometimes we won't know, in which case knowing that we don't know in itself has implications for policies. And some cases we'll say, the way this is looking, this is really going to blow up. I mean, you just read the newspapers, let alone what people are saying to each other, and you see how far apart everybody is on these answers. And I think a large part of that has to do that they're not agreed to a set of common facts. I mean, if you don't agree on the underlying, you can see that if you're having a debate at this table and they are operating with different assumptions, half of you think you're in London, half of you think you're in New York, half of you think it's nighttime, half of you think it's daytime, and now you're having a discussion. Do you see? You're probably not going to get anywhere. So establishing what the facts are, establishing as much as you can common ground, and then from there moving forward into the unknown or moving forward to judgment. Everything's a trade-off. and not everybody will agree where that trade-off should be. But at least I think we've moved things closer to some sort of a, if you want to call it, not rational, but a system that would improve on what we've done now. Because what we've done now, I think most people will agree, is inadequate, putting it nicely.
Yeah, this is not a policy question.
Where's my wallet?
So, many or all of the models that we studied at Sloan or wherever we went are based on require a risk-free rate. But a lot of what we've learned and what you've talked about, I'm out here.
There you are. Sorry.
Right. Yeah.
The gentleman
yeah.
between you and me. Now I can see you beautifully. Thank you.
Okay.
Thank you for your moving. Yeah. Go ahead.
Right. So we've studied all these models based on a risk-free rate. But what we've learned is there may not be any riskless assets.
Right.
So my question is, are there significant theoretical implications to a world in which there aren't any riskless assets?
Sure. That's a good question, and I would answer it in two parts. If you're looking at it where many people here who I recognize and who have trained at Sloan, who are in the asset business or something, you say, yeah, that's not a real problem. Fisher Black, had the theory, the capital asset pricing model with no risk-free assets. You take the minimum variance portfolio and you do everything like you would have, and all of that. However, I would say to you that in very large parts of finance, because finance, as Stu said, is very important. It's important because it interfaces with the rest of the world, not just among those of us who happen to be in the profession. And it's there, the riskless asset is very important. Think of just the following simple problem, or you have a pension for working class, millions of people. The defined benefit plan, they say if you work for the company at the end of your work life, you'll get 70% of what you earned in the last part of your work life. That with Social Security ought to be enough to live on. That's 15-second description. They say thank you very much. They don't think about it when they retire. That's what they get. Now, rewind it and say it again. When you get to retirement, if you work for the company all your life, we're going to pay you 70% of the average of your salary, we hope. But we may not pay you that. There's a chance that we won't. Now, do you see where the conversation goes? Well, then what do I get and under what conditions, and, because I wanted something to do about it. You see how complex that gets very rapidly? Would you like to explain that to 150,000 workers, or for that matter, brain surgeons in a hospital? The need for something that, from a communication point of view and that's risk-free, for many of what was come to be called Main Street, which I think is a misnomer. We're all part of the same community. But for those applications, make it very important. So I think in that case, for sure, I believe it's quite important. Once I've established the principle, it's like the old joke, right? Establish the principles, now we'll haggle on how much we need for how many different things. Okay. Well, thank you very much.